You may have heard about velocity banking. What is it? Is it worth it? And what are the risks to you if you decide to proceed?
You are listening to Wealth Talks with the McPhees. Velocity banking is also known as the HELOC strategy. You may have heard it as the Australian mortgage or the Mortgage Accelerator System. There's all sorts of names for this strategy out there, and here recently it seems like it's been making a comeback. You're going to get the inside scoop today.
You know, years ago, we had Harge Gill attend one of our events when we were back in Oregon, and he was all excited to find that the value in whole life insurance would exceed the value of a HELOC in accelerating your mortgage payment. And at that time, he told us that if he would have known about whole life insurance, which is not available in Australia, where he's from, he would have written his book, Own Your Own Home, years sooner using life insurance instead of a HELOC.
Interesting.
And yet today, people are going back to the HELOC and all of its risks associated with that instead of truly building lasting, sustainable wealth in life insurance and using that as the leverage to pay their house off earlier if that's what they want to do.
Okay. So as a quick overview, for those of you who have not heard of velocity banking before, what generally happens with the velocity banking is you have your primary mortgage, and somebody who decides they want to pay off their mortgage sooner will take a HELOC out on their home. And then banks will typically allow this. They'll allow you to have an 80 to 90% loan to value on a home. It's typically allowed for a second mortgage. So if your mortgage has been paid down somewhat, now they'll let you get a HELOC for some of the equity that you have in that. Typically, a HELOC will have a variable loan rate on it, so you have a little bit of uncertainty there. But one of the things that a HELOC does allow you to do is it's kind of like a bank account or a line of credit. It is a line of credit in the fact that you can draw it down or pay it off. So it's a little bit flexible in that regard.
And that's true only when the economy is humming along at a pretty good pace, because oftentimes HELOCs, once you pay it back, they'll reduce your line of credit.
They can do that.
In tighter financial times.
In tighter financial times, that's certainly a disadvantage. So the idea with using this HELOC is to take your monthly income and to pay a big chunk on the HELOC down, and then to get a debit card or something against your HELOC and use that to pay your living expenses. So you take a draw on that line of credit then to pay your living expenses when they actually come due. And supposedly that's going to save you about a month worth of interest on every paycheck that you put toward that before you pull it out to pay expenses. Depends on the amount of time that you have it in there, how much interest that's going to save you. It will save you interest. That strategy is called Paycheck Parking by many people. And it's supposed to save you that little bit of interest every month as you go along. And depending on how much that you pay towards it versus then take out for living expenses, if you're paying it down by a good chunk every month, then you can pay your mortgage off faster and your HELOC as well. How much faster? It's going to save you $1,000 or $2,000, maybe a couple thousand, and maybe a few months.
Well, that brings up a good question. And why are we in America still trying to pay our house off so fast? We hear the gurus like Susie Orman and Dave Ramsey and, the white coat investor and people like this always saying, get your house paid off. It's it's your biggest investment that you'll ever make. It's your best investment. And yet, according to Robert Schiller, the economist at Yale and Nobel laureate, he says that the value of owning your own home is really nil since 1890 because of inflation costs. So, for example, between 1989 and 2019, that's a 30-year span, real estate only went up about 113%. That's all because of inflation. That's not because the value of your property went up. Because if you would have taken your mortgage payments and you would have just earned a little over 1% on what you were earning on your mortgage payments, you would have had a better investment than your home.
Interesting. So are you saying it would be better to not pay off the mortgage early, pay a little bit more interest to the bank, and have the use of that money elsewhere?
Well, I think the better way to do this is to look at using other people's money. That's what Warren Buffett says is the best way to create equity. Let's use the bank. Let's extend the mortgage as long as they'll give us. And let's act like we're going to spend the money that it would take to pay the house off early, but put that extra money in a safer, more productive, more reliable, more guaranteed place that will assure that if something happens to us, the home will be paid off for those we love. And of course, those of you listening to this podcast know that's whole life insurance.
Yeah.
Because if you will pay the extra payment that it would take to pay your house off in 15 years versus a 30-year mortgage, but take the difference in the mortgage payment on a 30 versus a 15-year mortgage, and you put that aside in a life insurance policy, by the time 16 years comes around, you'll have enough cash value in the policy to pay the rest of your mortgage off if that's what you want to do. But if you never pay another premium into that life insurance policy after that first 15 years, then by year 30, you will have the cash value that replaces everything you paid for your mortgage over 30 years. Now you got the insurance and you got the house. Whereas, this velocity banking stuff, all you're doing is feeding the banks more.
You're feeding the banks more, and if economic hard times come, they can cut that line of credit down, and then you're the one in the tight position.
Then you're the one in the tight position, owing all that money on your home.
Yeah, and with the HELOC, supposedly you'll be able to access the money out of it when you need it. But if you aren't, and it's an economic downturn, that's the time that you lose opportunity, and that's why the whole velocity banking thing assumes has a very big assumption that saving on interest payments is the most important factor in paying off your mortgage. That's not necessarily true.
That's not necessarily true, and that's why we always say that debt is not a dirty four-letter word as long as you're managing it. If you allowed debt to manage you and you start getting compound interest working against you, that's when it becomes dangerous.
Yeah, and another assumption with the velocity banking is that the equity in your house counts as savings. And that's not necessarily true. Why is that?
Well, Peter Lynch has said that savings and investing are the same thing today. They're synonymous. Because
in people's understanding, I would say that's true.
That's exactly right. And so that's why we draw the line between the difference between keeping more of your money and saving more of your money. Yeah, your home might be the biggest place you park a lot of money, but that money's not parked in your account. It's parked at the mortgage bank. You pay that off, the bank has all your money, and you have a liability because you've got the insurance, you got the property taxes, and you got the maintenance. And those three things will destroy the value of your home the longer you live in it because you don't get that money back. It's only the inflated price of the home that you get. You don't get the interest rate, you don't get the property taxes, and you don't get the maintenance back.
No, those are always going to be costs.
Yes.
And think about it this way. I think we may have used this example on a previous podcast show. It's been a long time ago. If you have a mortgage that's almost paid off and you miss a payment, is the bank going to be faster to take away the property from you, or is it going to be faster to take away the property from your neighbor down the road who just took out his mortgage and missed a payment?
Well, the bank has all the money that they're probably, most of the money they're going to get from you if you just have a few years left on your mortgage. Whereas if someone is just starting a mortgage, they have not even come close to breaking even yet. And so it's much easier for them to take action on a home that's almost paid off versus one that isn't. And
much higher rate of return for the bank.
And we've paid several homes off in our lifetime, long before you probably remember, John. But Michelle and I, we've paid houses off, and when the economy turns south, then and things are tight, then you've got to worry about the property taxes because a property tax lien can take your house away too. And so if you can't afford the taxes on your home, even though quote unquote you own it, which is questionable in the United States anymore, whether you own your own home or not because of the tax liens that can take it away from you, then that doesn't give you the confidence of knowing that it's really yours. Mm-hmm. And so even though you do pay your house off, that may not be the best option for you, because now your money's all tied up at the mortgage bank, and if an opportunity comes along, you are asset rich and cash poor. Mm-hmm. And that's one of the reasons that when we're looking for life insurance companies, we're always looking for companies that have a cash surplus in comparison to their assets. The more cash value they have, that means that they're more liquid, they're more flush, they're managed better. Mm-hmm. Because if we tie up all of our capital in assets and have no cash flow, we got a problem. Now we can't live day to day.
Yeah. So one of the big benefits of putting extra money into whole life insurance rather than into your mortgage is because it's more accessible.
Yes.
Especially during down market times, and it gives you better leverage power with the bank if in the worst case scenario.
That's correct.
So yeah.
Yes, absolutely. And we never know when opportunity is going to knock, and if we have more cash on hand, which the life insurance allows you to access the equity in it, whereas much, much more difficult to access the equity out of your home.
Yeah.
Especially in tough economic times.
Yeah. And tough economic times, maybe this is macroeconomics or maybe it's micro. I mean, maybe it's a national economic problem, but sometimes it's just a personal economic problem. Someone in the family gets sick. Exactly. That can be a personal economic problem, even if the economy is buzzing and humming along in the big world outside.
And we have examples of that just within our clientele. One of our clients had a spouse that had a heart attack. They were a foreign national. They were not a native. They were not an American citizen, and so there was this issue of who was going to pay for this. Mm-hmm. And they thought, no problem, their house was paid off. They would just go to the bank and get a line of credit to pay the hospital bill. And they were denied a home equity line of credit, even though their house was paid completely off, because their income stream was not sufficient enough to justify the repayments on the loan. Hmm. So just because you own your home doesn't mean it's something that is accessible at the equity. The only way a lot of people are then able to access anything out of their home is to sell it. Mm-hmm. Because, like you said, it could be a micro instead of a macro problem.
Yeah. Yeah, it's important to have that reserve. And that's one of the downsides with the Paycheck Parking strategy that's part of Velocity Banking is that you're tying up all your extra free cash flow every month. It's all tied up in that one mortgage.
Well, and this is an age-old axiom, but cash flow is king. Mm-hmm. So that is why credit cards tell you can buy this $2,000 item and only pay a minimum payment of $25 a month. They know that giving you extra cash flow is going to entice you into purchasing more than you normally would. So it's this, in reverse psychology, the more cash flow you have available, the better off you are, as long as you're disciplined and not go and spend it excessively, but use it on opportunities that are going to make more money. Yeah. And the HELOC doesn't necessarily give you as much liberty as a life insurance policy does in freeing up cash flow. Totally.
So will Velocity Banking save you money? If you diligently implement it, yes, it will save some money. It may save a few months of time. Will it be more involved with moving money around? Yes. And the answer to that question is also yes. Does it give you as many options along the way as using life insurance as along with this? No, it does not. And I think one of the, when you consider it in this light, the question arises, well, why has Velocity Banking in its many different forms and brand names, why does it continue to be so popular today? It's more of a philosophical approach rather than a mathematical approach. It will save you some interest, theoretically, but in reality, we don't know exactly because we don't know exactly how everything's going to play out. But one of the reasons I think that it continues to be popular is because the people promoting it promote it with a little bit of an MLM angle on it. They're selling a subscription for consulting to go along with it to help you stay on track, or in some cases, software to help you manage everything every month. It's adding a little bit of a layer of complexity to everything that they can charge for. What do you see with this from this perspective?
I think it's a little bit more complex, too, for a lot of people, and so they are going to need those extra services just to help keep the tracking going so that they are kept disciplined enough to make this work.
Yeah,
because it does take discipline.
Yeah, I mean, if you have this line of credit and you use it, now you've just dug yourself a deeper hole with some debt.
Absolutely. So, they could save themselves a lot of time by just going to moneytools.net and picking up your calculators, John, and tracing their HELOC through that instead of paying a service fee, because that's all it really is. And we saw this need years ago when people were taking policy loans and they weren't keeping track of how they were paying it back or what interest rate they were earning versus what they were paying the insurance company. And if you don't do that, you really have no idea of what you're doing, whether you're saving money, losing money, or you're just playing, a shell game. And so that's why you went ahead and developed moneytools.net. Those calculators are very, very important if you're going to get involved in, quote unquote, the banking process, and that is arbitrating between interest rates of who you're paying and what you're keeping.
And there's nothing wrong with arbitrating between those rates like that. That's why a lot of people, rather than rushing to pay off their mortgage today, when interest rates are low, between 3% and 4%, they'll put the money into life insurance instead because they know it's going to grow about that fast in the life insurance, and now they can start two things instead of just one.
I remember back years ago when we first met Nelson Nash and we developed the IBC game, kind of like a board game like Monopoly, trying to teach people that where they borrowed money, whether it was from a HELOC, a 401k, or some other line of credit, or whether they borrowed it from their life insurance policy or paid cash. And when we did the protocol test on that, we had about 25 life insurance agents in the room that we were having play the game, and they could not do the math. And that's when we realized this is a huge problem. These are people that are teaching others how to do this, and they don't know how to do the math. And so that's what the money tools evolved from, is that you realize that this math has to be done for people. And that's what these people that are selling, velocity banking are doing too. They're monitoring this to make sure that what is happening is going. But it takes a lot of discipline.
Yeah, it does, and it's a service that's needed if people are truly going to go for that.
Absolutely.
I was talking to some people, some Canadians recently. They were looking at doing this, and the HELOC rates can be a little bit higher, and or policy loan rates are a little bit different than they are here in the United States. And so, if somebody's going to use a HELOC like this, the interest rate is extremely important.
It is.
If you have a high interest rate on a HELOC, it obviously makes sense to go ahead and pay that off, similar to if you had a high interest rate. But when you have a low interest rate, it doesn't necessarily make sense to take a policy loan if the policy loan rates are higher to pay off a mortgage at a lower rate.
Yeah, and so, that's really amazing.
That's really where it comes down to the banking part again.
It does.
Arbitrage between the rates.
You've got to be looking at how those interest rates pay out, because paying interest on a principal, and if you're paying the principal as well, you're going to pay less over time on that loan than what you could earn at the same rate if it's compounding on that same amount.
Sure, because it's a decreasing balance.
However, when you're just pulling a line of credit back and forth, those interest rates become even more convoluted that need to be watched and made sure that what you're doing is actually saving you money or keeping more of the money you're spending. Now, all this talk about paying your home off early, we are not talking about rental property. We are talking about your residence. Because when we're talking about rental property, we're getting into a whole nother aspect. We're talking about investments now. And with investments, there are deductions that the IRS really favors rental income for. So you got depreciation, you got deduction for the interest and things like this that are lost with the tax code today for most people on a home.
Yeah. I mean, you have the interest deduction on a home mortgage. That helps you a little bit. Effectively lowers your rate. But with the rental, the depreciation, things like that, absolutely.
Yeah, and many people lost the home deduction interest rate because of the new tax law that went into effect, because now
the standard
deduction is more than that.
True.
So it's important that you understand this thing. We're here to help. That's what we do day in and day out, is help people keep more of the money they're making. We're not investment advisors. We don't want to tell you what to do with your money. We want to help you see the consequences of what you choose to do your money is going to be.
That's right. So if we can help you see what's going on with your mortgage so you can accomplish your goals, whether you want to pay that mortgage off, whether you don't, whether you want to accumulate some of that money in a place that you can control, where you're keeping that money, not just saving or investing it, which is so common today, give us a call at 702-660-7000. We can help you look at a life insurance policy, see if that's going to be in your best interest for planning your financial future. And something that we always say is we don't give financial advice because we believe that when you're educated, you're the best one to make those decisions.
Absolutely.
When you have the knowledge, when you see what's going on, then you will know what to do. And that's at the core of everything that we do.
The American people aren't stupid, John. They just may be unwillingly ignorant because of the propaganda that's been talked about different financial things.
There's a lot of misinformation out there.
And so when they know the truth, they have no problem making the right decisions for themselves. And those are their decisions then, and they can move forward in confidence because they've got the knowledge to back up what they're doing.
Absolutely. You're listening to Wealth Talks with the McPhees. We'll be back next week.